Hello, good afternoon, and namaskar. A very warm welcome to one and all joining us today. My name is Bhumika, and it is with great pleasure that I extend a heartfelt welcome on behalf of the complete SARE team to this yet another session of the South Asia Energy Series. The South Asia Energy Series on electricity derivatives is focused on mitigating power market risk and electricity derivatives. As many of you already know, that this online event is part of the USAID South Asia Regional Energy Hub, which we also call as the Hub. This is in coordination. This is the coordination and the communication platform within the USAID's regional flagship program, that is the South Asia Regional Energy Partnership, which we also call as SAREP. Under the hub, we take up topics of interest in the energy sector, which are of great importance or have increasing relevance in the South Asia energy sector. Given the critical role that electricity derivatives play in hedging price risk, being in the domain, we think it is important to familiarize oneself with the concepts of electricity derivatives, their product features, global practices, and their use in conjunction with the physical delivery of electricity from a short-term trading perspective. In this context, USA, through its South Asia Regional Energy Hub, has organized this South Asia Energy Series on electricity derivatives on mitigating power market risk for regional power stakeholders in the South Asian countries. This is the first session in this electricity derivatives series, and we'll have a couple of more sessions in the upcoming months in association with regulators and policymakers, commodity exchanges, and power market participants. I also encourage all our participants to actively engage and ask questions in the Q&A tab. After each speaker, we'll have a Q&A session, so we'll be happy to take your questions from the Q&A tab. In case there are any problems in the AV setup or anything, please let us know in the chat box on your screen, and we'll be happy to help you. So now, without making much time, let me invite Ms. Monali Zia Hazra, Regional Energy and Clean Energy Specialist from USAID India. She has more than 25 years of experience and has managed several USAID clean energy programs, including regional power trade and markets, renewable integration, cleaner fossil distribution reforms, and smart grids. Over to you, Monali, for your remarks.
Thank you so much, Bhumika, and good afternoon to everyone on this South Asia Energy Series, which is being organized by South Asia Regional Energy Hub, or the Hub, as Bhumika just mentioned. I'm Analizia Hazra from the Indo-Pacific Office in United States Agency for International Development. Many of you may be familiar with USAID, and specifically USAID's work in South Asia, focused around enhancing energy cooperation, regional energy cooperation through cross-border power trade and power markets, development of power markets through various interventions. One of the positive aspects, I always feel that, USAID has been working in the region since 2000, and now when we compare to where we were and what is currently happening, it's very positive that cross-border power trade has increased significantly, almost 4 times since 2012, and it's due to the efforts of the various stakeholders, including the the country governments, through the various conducive policies and regulations which have been brought in. And in the recent past, we have seen that market-based trade in South Asia region has also increased significantly. And we have currently, Nepal and Bhutan participating in the Indian Energy Exchange, and we are also hoping and expecting that Bangladesh will soon join in the power exchange, and do market-based trading mechanisms. So again, USA, through its earlier program, which we used to call as SARI, or South Asia Regional Initiative for Energy Integration, and now through its new program, new regional, not new as in we are already 2.5 years, but compared to, this is our latest edition, or South Asia Regional Energy Partnership Program. We have contributed to the efforts on the cross-border power trade and market-based trade by creating, helping and create a enabling environment in strengthening institutions, human and institutional capacities, as well as building awareness on various themes and topics. We partner with national and regional institutions in our endeavors, as well as many of the private sector, and one of them we are partnering today, MCX, for this particular edition. Now, market-based power trade is anticipated to play a larger role in the overall trading landscape in the region, as the markets mature in India, as well as new markets open up in other countries. And market products like derivatives can play a very significant role by helping hedge price volatility risk for the market participants. We also understand that there are some development within India with regulators, both SEBI and CRC, working on creating the framework for introducing electricity derivatives. How USAID comes into the picture, we aim to assist the regulators and the market participants in introducing the necessary products on enabling environment for electricity derivatives, as well as creating more awareness and knowledge about this new product, and do various interventions through knowledge papers, dialogues, capacity building workshops, and so on and so forth. And this is an effort towards that. South Asia Energy Series, as again mentioned earlier by Bhumika, is organized to enhance understanding of newer products and new innovations and new topics and themes. And electricity derivatives seems to be is a new upcoming theme which we would like to focus on. So this is the first in the series which we will be hosting on this particular topic. SARE, or South Asia Regional Energy Hub, or the hub as we call this, it's a coordination and communication platform with the objective of enhancing knowledge and knowledge about newer products as mentioned. So we hope to not only bring to you newer themes on market, but also on other technologies. And we hope you enjoy the session. If you have a feedback and you would like the SARE or the hub to organize, energy series, knowledge series, webinars, please do leave your comments in either in the comment box or on the questions, so that we can take up those topics in future. It is open to all the South Asia stakeholders, and we hope that this will be useful for you. With that, let me once again thank you for joining us today. We hope that this is for us, it's an important session, but we hope you enjoy it, and we look forward to hearing your feedback on this. With this, let me turn it back to you, Bhumika. Thank you.
Thank you, Manali, for your remarks and also setting the tone and giving us such a background of this energy series. And regarding the feedback, so you'll also receive a mail after this session is completed. So you can in fact reply back to that email with your comments, suggestions. We'll also share a feedback form in our thank you email. So using that also you can give us your comments or feedback, any suggestions you have. So with this, I'll just, before we start the technical session, so let me request all my speakers and all the panelists to please switch on your camera so that we could just have a group photo together virtually. Ruchi, Namrata, Rajesh ji. Okay. Rajesh ji, if you can also. Okay, I think maybe he's not on the desk. So we'll move forward with our sessions, and to begin with our technical sessions, let me invite Pramod Thakur. He's my colleague from SAREP, and he's a power trade expert. He brings in with him over 18 years of experience on power sector consulting, trading, infrastructure planning, and implementation. He's working on the areas of cross-border trade in the South Asian region, involving implementation of market-based trade mechanism, strengthening power trading entities, formation of regional forums, capacity building, etc. So over to you, Pramod, for the context setting and introducing our speakers and taking forward the technical sessions.
Thank you, Bhumika and Monali, for setting the initial context and giving me this opportunity. Let me just share my presentation with you all. I hope I'm audible, Bhumika, properly.
Yes, absolutely. Yeah.
Okay. And the presentation is also on the full mode.
Yes, perfect, perfect. Yeah.
Okay, great. So in the next 10 minutes, I'll just briefly tell you about why we have come up with this program and what is the context in the South Asia region, why derivatives are important, and I'll also try to share towards the end some basic concepts of financial derivatives, which of course will be dealt in the greater details by our subsequent speakers. So, why we have set this series is basically to promote a sustainable market-based electricity trade mechanism. So currently there are power exchange-based mechanism which is there, and the various countries are trading into this mechanism. However, there is a price volatility, which is one of the key aspect which creates a concern. However, in order to have a sustainable market, we need to have this derivative as an instrument, which has been explained by earlier speakers also. We also would like to create the facilitate and create the derivatives market in India, electricity derivative market to be specific. This has not been introduced yet, and any action from our side through a dialogue, through a facilitation on policy and regulatory actions, and support for implementation in India, as well as if this can be taken forward to the regional countries, we'll be happy to support in that areas. One important aspect would be building the institutional and individual capacity among the policymakers, regulators, utilities, private sector organization on hedging products. So this is one of the key objectives, and also increasing the awareness of the electricity derivatives by sharing international experiences, case studies among the key power market participants. So these are the some of the objectives through which we have set this. And last year, some of you might have also attended our power exchange, short-term power exchange based training, which was again a virtual training, and this is in continuation to that last training. So giving you the context in the South Asia region, if you'll see that in Nepal, mainly the tradings are happening through the bilateral trades, and which predominates. Also with India, it has been the predominant case earlier. However, there has been a significant portion of the quantum through which Nepal has been buying or selling the power from the India through the power exchange, Indian power exchange mode. Also, recently, India and Bangladesh has signed an agreement to export close to 10,000 megawatts in next 10 years, and this will possibly also have an element of market-based mechanisms also. So possibly some of the power will be sold through the power exchanges or in other markets also. In case of Bhutan, they have been a net exporter to India. However, since last 3 years, they have been buying power through the power exchanges, and recently in the last calendar year, they have also started selling in the Indian power exchanges. So there has been a significant change or in the demand which has been seen in the Bhutan because of the industrial activities, and I think in the last 3 years their demand has almost doubled from 400 megawatts to close to 900 megawatts this year. Similar is the case for India, wherein the demand or the peak demand is increasing very fast, and close to 7 to 8% of the trade is definitely happening through the power exchange based mechanism. There are other mechanisms also, which we'll be discussing in the later slide. Also, there has been a rapid increase in the renewable portfolio, and this creates an intermittency in the power exchange in the power market. The regulatory landscape in the India and the market itself is changing because of lot many new concepts are being introduced, and there has been a very frequent change in the regulation which impacts the short term as well as other market participant markets. In case of Bangladesh, you'll see that bilateral trades have been in the dominance, and earlier they used to depend on the domestic gas, and now they are shifting to the import fuel based generation. There has been a very significant increase in the reliance on import coal, gas, and oil for generation of electricity in the Bangladesh. Also, they are relying heavily on India. Close to, I think, 10 to 12% of the electricity is being imported from India, and more than that, of course. But so far they have not come to power exchanges, but there has been active discussions that they will be in very soon will be participating in Indian power exchanges and maybe buying or selling the power through that mechanism. In case of Sri Lanka, again, the country has been in the last 2 3 years have been struggling with the financial situation, and now they are in the recovery part. The reforms and the restructuring in the electricity market is going forward at a very fast pace, and there are the discussions around cross-border electricity trade is also advancing. So in summary, if you consider that the trend is showing that the market-based trade is increasing in the region, there is a reliance on the import of imported fuel-based plant. Intermittent renewable energy is again a very clear trend in the region, and the power market is developing day by day. So these are some of the key trends in the context of South Asia. If we'll see the some of the key risks which are associated with the electricity trade in the region includes the change in the power market structure, the regulations which impacts the trading quantum, the prices, the processes. Similarly, increase in the peak demand is also creating a significant challenge for the buyer or a seller, and it which necessarily creates an option. A challenge for the especially the distribution companies to always tie up or look forward for the market based mechanism to source the peak power. There is always a variation between the demand and actual, and which creates again a problem for moving to which also creates a direction for moving into the market based mechanism. Technological changes within the generation technology, as well as there are a lot of smart meters and other data sets which are data related technologies which are available, and a lot many data which is available with the power sector stakeholders to analyze and to use them in for future cases. Geopolitical disturbance is among the key issue in the region, and in the last because of the recent ongoing conflict in the Europe, we have seen that the import fuel prices have increased significantly, and which has also increased has an increase in the availability of the forex by the South Asian countries. Again, since many of the countries like Nepal, Bhutan, India, Sri Lanka are dependent on the renewable energy for electricity generation, weather change creates an issue with respect to the generation profile as well as on the demand side. Price volatility is another major concern in the short-term market. So we have few slides in the next few slides which will explain you all these things. In terms of politics, elections are going on in the region, and any change in the political regime also impacts the power market, and also the some of the freebies are also being introduced by the some of the parties, and which impacts the overall financial health of the utility. So these all things impacts our power markets. There are delays in the generation or transmission projects, which creates a problem for planning the trading activity. And then there are other issues relating to the payment and forex related matters. So these are some of the key concerns for trading electricity. In case of India, if you'll see the short-term trade, which is less than 1 year, comprises of close to 14%, and it is increasing gradually. There are 3 power exchanges in India, and there is one centralized portal through which this the power is being traded. And in terms of percentage, close to 6 to 7% of the power is being traded through the power exchange, and which close to 18 billion units. This is a graph shows the monthly quantum for the India from the spot market, day ahead market, and RTM market, which are the most liquid markets in Indian power exchange. Similar is the case for Nepal, wherein Nepal has been participating in Indian power exchange since April 21, and they have been buying as well as selling the power in the Indian power exchanges. And if you'll see the graph, there has been a significant rise in the quantum from on an average 50 to 60 million units to now close to 250 million units. And there are plans that they will be subsequently selling a lot of power through this power exchange mechanism as well as bilateral mechanism. Similar is the case for Bhutan, and they have commenced participating in Indian power exchanges in January 22, and they have been consistently buying only into the winter season. So in 2022, you will see that in the 3 months they have drawn power. In last year, they have drawn power for the 4 months, and this year they have started selling power. The blue line, if you'll see, they have started selling the power, and the quantum this year has also significantly increased from 100 million units to close to 300 million units. So what are the price trends? So if you see the monthly average, there has been a variation in the prices from close to 6-7 rupees to less than 4.16. And this is for the day ahead market, which is planned in day in advance. Similarly, on the real time market, for which trading happens for a half an hour time block, there has been more variations. However, the trend remains the same. So overall, if you'll see, the lowest price in the day ahead average prices were 4 rupees and the highest price was 6 rupees, and there is a variation of 2.28 INR. The volatility has been more in the RTM market, where the volatility has been close to 3.31 rupees. Once we see the daily pattern, we'll realize that the volatility increases in the daily basis. So this is a typical graph of a day, and I have taken the data from 13th February from the leading exchange, and the prices in the night time, if you'll see that the prices are close to 3 rupees. However, during the morning peak and evening peak, the prices touch to close to 10 rupees. And during the solar hours, the prices are again pretty constant, close to 4 rupees. And the similar trend has been seen in case of real-time markets also. However, if you'll see the variation in this, there has been a significant high variation from low to high value, and close to 7 rupees difference is there. Again, this 10 rupees has been capped by the regulators. So if this is kept open, then the price variation can go significantly higher also. So what are the options to handle this volatility? One, of course, is improving the business operations. So enhance the demand assessment accuracy, predict and planning the generation very carefully, and enhancing the capability of power trade using the advanced tool, or improve the power system operation. And of course, last not the least is managing imbalance. And the other alternative is to hedging your risk through electricity derivative. However, we foresee that there is a combined approach between these two will help us hedge the risk very properly. And because of this context, we are bringing today's session. This is our plan in the series. So we are starting with the first one, usage of electricity derivative as an hedging tool. Subsequently, we'll have a regulators and power markets dialogue with possibly bringing SEBI, CRC, and other power market participants. Then we will also try to share some of the international experiences with the use cases. And also we will try to share with you the fundamental concepts on financial derivatives and electricity derivatives. Towards the end, once the market product is being launched, then we will also help you understand about the market products, its features, and its practical trading aspects. So these are the timelines. So maybe in next 2 to 3 months, we will deliver 2, 3, and 4. And the last one, the 5th one, once the market is launched, we will try to share that experience with the leading exchanges. So some of the key aspects relating to the session would be, you please put your Q&A in the question answers in the Q&A box. We will share the presentation and recording in next 10 days time. You will be required to register separately for all the subsequent sessions. However, we'll be sending you the links for our upcoming sessions. Also, as Monali has already explained, please provide your feedback. This will help us improve the delivery models. So this is the plan for today's agenda. So we are having two technical sessions. First one is led by the largest commodity derivative exchange, MCX, and they will be delivering a session. They will be discussing on the introduction to derivatives, international experiences, current status, some of the product features which they are planning, and how the pricing will be discovered, how the clearing will be done, and the high level procedural expectation. After this, the second technical session will be delivered by the largest electricity trader in the South Asia, and they will be sharing the electricity trading perspective and the potential use cases for from the generation, discom, and C&I customer side. So these are our speakers, Ms. Ruchi Shukla. She is Head Energy MCX India, and Mr. Rajesh Charyali, who is a Chief Strategy Officer, PTC India. So before I give it give it to Ruchi, I just have a few slides on the basics of financial derivatives, and I'll take another 2 minutes. So financial derivatives are basically the financial instruments whose value is derived from the underlying assets, index, or rates, and they are generally used for hedging the risk or speculate or arbitrage between the markets or products. So just to give you a basic perspective, that there is an underlying asset which has a varying prices, and our particular derivative derives its price from the underlying assets value. So this graph shows that these are the basic or the important financial derivatives. So the future contracts are the among the important derivatives, and these are standard agreements to buy or sell specific assets at a predetermined price on a future date, and these are traded in the exchanges. Another derivative is the options derivative, which gives the holder the right to buy but not the obligation to buy or sell the underlying asset at a predetermined price within a specified period. Forward is similar to future contract. However, it is basically a customized contract, and it is traded over the counter. Swaps are another important instruments, which are basically agreements between the two parties for exchange of cash flows or financial instrument over a specific period of time. And some of the common types of swaps are interest rate swap, currency swaps, commodity swaps. Another important derivative in the context of electricity is the contract for difference, wherein the financial contract difference between the two parties, where the seller agrees to pay to the buyer the difference between the current value and the underlying assets and its value at the time when the contract is being settled. So these will be further discussed and much elaborated in much details by our next speaker. So our next speaker is Ms. Ruchi Shukla. She is a chartered accountant with over 20 years of experience in financial and capital market, mostly in the product development, specialization in energy sector, policy and research advocacy. She has done DISA and security market and advanced business analytics from IIM Ahmedabad. She has worked with a wide range of organizations, including regulators, stock exchanges, banks, and she was also appointed as an expert consultant by Forward Market Commission, Government of India. Presently, she is superheading energy products and strategic initiative at MCX. She has also received very prestigious awards like CA-CXO Award in 2024, and also Women in Commodity Award in 2023. So with this, I'll stop sharing my slide and requesting Ruchi to please share her views.
Good afternoon, everyone. Am I audible, Pramod, properly?
Yes, you're
Okay.
audible.
Thank you so much. At the outset, I would like to thank Monali, Bhumika, Pramod for coordinating so well and getting this series organized, which is probably the need of the hour for the Indian markets, definitely. Just give me a moment to stream my slide, please. So Pramod has already set the context for today's discussion, particularly electricity derivatives. So how I propose to take on is just to first set how what derivative markets particularly constitute in Indian, what are the rules, regulations governing those derivative markets, what is this exchange mechanism, and then obviously why there is a need and this is the right time where electricity derivatives should be permitted for Indian market participants. And obviously we'll run through some global overview of how derivatives help and spot markets have complemented each other across the globe and developed into a lot of number of new products as well. So commodity market ecosystem, basically most of us are aware the spot on the commodity side, the spot physical markets where we go and take the delivery on an immediate basis. Just to cite an example, then there are on the wholesale level, there are APMC markets for agriculture. For bullion, we may go to a jeweler, etc., and go on and purchase. And for electricity, definitely as a different type of a commodity, we have bilateral contracting, particularly because this is a non-storable commodity. And then in the spot, we have forward contracts. Forward contracts are basically one-to-one, they are not standardized, but one-to-one bilateral contracts are called forward contracts. And then there is a whole system evolved of financial markets. So basically they are the derivatives, and as per the regulatory regulations in India, SEBI is the regulator for derivatives market, which is governed by, which is formed under SEBI Act and is governed by Securities Contract Regulation Act. And then we have stock exchanges and clearing corporation regulations, basically, which govern this ecosystem besides various other rules, regulations flowing through. Going ahead, under SEBI, there are stock exchanges. So most of the participants here would probably, I must be aware, like the stock exchanges where they buy in equities like NSE, BSE. So there are now, post SEBI took over from FMC in 2016, stock exchanges is a common terminology which is also used for commodity derivatives exchanges, wherein one is MCX. And then under stock exchanges, there come members. So members are basically the broking houses, like the before going ahead, sorry, I forgot to say this is a disclaimer required under regulations. So whatever I am speaking here is only from the purpose of awareness creation or maybe exchanging the views, and nothing here is any kind of a propagacy or something to buy on the derivatives or the commodity derivatives. So whatever we discuss is only for exchanging knowledge purpose. So under stock exchanges, there come members, wherein members will be the stockbroking houses. Like in the banking sector, we have ICICI Securities, then we have Zerodha, Motilal Oswal, IFL, any kind of, these are the members which fall under stock exchanges. And then under members become clients. So clients are how we participate. So like, just citing you the equity example because most of us are aware of how to participate in the equities. So equity side, the similar concept runs for commodity derivative exchanges as well. And there are two kinds of actually derivative instruments which are permitted by the regulator, those futures and options. Currently, only these two types of instruments are permitted in derivative markets. If we talk of commodity derivative space in India, so there are four different segments which are very popular: energy, bullion, base metals, and agriculture. So under energy, so MCX is the leading commodity derivatives exchange with around 96% market share. And the other exchange is NCDX, which is more in agriculture. So we are have a largest market share in non-agri products, while the other exchange has it in agri products. So under energy, we have currently crude oil and natural gas. Then in bullion, we have gold and silver. Base metals, it is the entire gamut of copper, aluminium, lead, nickel, zinc, steel. And then in agri products, there are a lot of products available like cotton, kapas, menthol, chana, barley. And various other products keep adding, or sometimes restrictions are imposed in agri products. Particularly, SEBI has notified 91 commodities. So derivatives in India can be launched only currently out of these any 91 commodities. And this list gets updated on a regular basis, as in when the regulator or the need of the market is, or the regulator feels the need for the market. Electricity is covered under these 91 commodity lists. So MCX, I've already set the stage. These are just the numbers basically. So if you see futures and options, futures we are doing around 20,000 crores on an average daily basis, and options we are doing around 80,000 crores on an average daily basis. Options is a more popular instrument basically because it's a more cost-effective instrument. So that is, these numbers particularly are I wanted to highlight not what basically, yes, MCX is the leading exchange definitely, but along with it, these numbers also show what kind of liquidity is available. So in any derivatives market, like if any product you want to participate, if liquidity is high, then your entry and exit are high, the impact costs are low. So that is why it's better to participate on a liquid exchange rather than on a non-liquid exchange, because it creates much more problems of exiting from the commodity as well. I'm setting the stage first. Let's like to basically understand, because as I guess most of you are already who have joined in are aware of how the power markets physically operate in India. But so I'm putting more emphasis on what derivative market space is, as this is coming as a very new set of market for the power sector value chain. So what is the purpose or to set up an exchange on the commodity derivatives exchange, and what does it satisfy as well? So basically the first purpose of any commodity derivatives exchange is price discovery. So price discovery, which has to be on a transparent basis. So in a commodity derivatives, the contracts are standardized. So whatever the contracts, they cannot be the contract specifications, so cannot be changed or altered at all depending on any counterparty. Then the counterparties which are participating here are on anonymous basis. So buyer and seller won't know each other. So it's an anonymous participation, which obviously brings in more transparency. And prices, yes, these prices are publicly available. They are published on the website of the exchanges. They are published on the various market data vendors across who publish it across. Then predominantly these are online markets and highly. So price discovery, it's on a transparent basis. The next is the price risk management. Derivatives globally is a very popular instrument for risk management purposes. That's the main purpose which derivative markets are to build, and that's the reason why electricity derivatives are needed for Indian markets. Facilitating physical trade, though this is not true for the electricity side of it right now, because electricity, what is being proposed, we already have spot exchanges. So the contracts here are different, but there are commodities like gold, silver, or base metal which are on delivery basis. So there the participants also can take delivery. And obviously enhancing credit flow, because derivatives obviously lead to financialization of the commodity markets. It's a leverage product. So it helps to build on and smoothen the credit flow within the industry. And it is also an asset class. Basically, any set of exchange participation is not complete without the financial investors. So you got to have to build on this liquidity. We got to have multiple types of participants, which besides value chain who come as hedgers, then there are financial investors, where we'll talk in detail on the other end. since it's a leverage product, and even the cost of participating on an exchange is very minimal. Besides your brokerage and all, cost of participation is like on an average realization is 222. So if I mean to say 260 rupees per crore of transaction, that's a kind of transaction fees which is charged by the exchanges. So which is quite minimal. Now, commodity, unlike the physical market setup, this is a very highly regulated market structure on any exchange. And this market structure, we have to follow a lot of rules, regulations, margining, and manage the risk. Because when when you're entering into a bilateral contract, there is a credit risk you undertake of the other party you're entering the contract with. But in an exchange setup, the exchange provides novation. Basically, novation means exchange provides you counterparty guarantee. So when a buyer and a seller are participating on an exchange, the buyer is entering into a contract with the clearing corporation of the exchange. Seller is entering into a contract with the clearing corporation. So the pay-in payout or there is zero credit risk, because that is a guaranteed, the counterparty risk is guaranteed. So to give this sort of novation, the risk management with the exchange develops by itself. This is first is obviously across the globe, margining is considered to be the best form of managing the risk. So there are margins at the exchange level. First is your initial margin. Initial margin, whereas it's based on span margin, which is a global, again a global terminology. Span is a CME patented product. So there's an initial margin. Then there is an extreme loss margin, which the exchanges introduce depending on if in particular times the commodities become more volatile. Say if I cite electricity, then there is a lot of seasonality seen in the electricity. So depending on the times where the demands are higher or the supply is less, the extreme loss margins are introduced to balance the availability. Then there are additional margins and concentration margins. So concentration margins are basically member level margins, because every member, like if a number of clients are participating through a single member, then the concentration, if concentration of the member on the exchange is high, then this kind of a margin is imposed on those particular members. Then there are other risk mitigation measures, or maybe I'll call them more as a surveillance measures. The real-time margin utilization. So there are different levels at 60, 75, 90%. There are alerts generated at the exchange. These alerts are sent to the members when their margins reach those levels of utilization. And at 90%, it's a risk reduction mode, means if suppose a member has hit the 90% of the margin limit, the member will be put in RRM mode and they cannot increase the position, they can only reduce the position. And obviously at 100%, then the exchanges have the right to square off. Then there are online mark to markets. Mark to market is a concept in the exchange because the open position which you leave at the end of the day, that's mark to market. Then there are DPR limits, obviously the range, the price ranges. So those are the price limits on daily basis. Then self-match. So it's like a PAN-based mechanism. So at PAN-based level or UCC level itself, you cannot match your, like buyer and seller cannot be the same. At the order level only, that is restricted. So these basic checks, basically why I highlighted this was probably, as we go ahead and see, still the regulators are not out with the approvals for the derivatives. And this kind of mechanism or the risk mitigation and surveillance measures are the measures which can help to create a balanced system, even in the spot market side, spot exchanges side, so that we can have a congregation of the derivatives and the spot well, and the derivatives can be launched in a more smooth manner in Indian markets. These are again certain surveillance and investigation. I'll not run through a lot, but these are certain investigative measures or surveillance measures put in place at the exchange, basically to avoid any kind of manipulative pricing in the markets or manipulative trades happening on the markets. So now what is basically risk management? Most of us, maybe on the corporate side, we are aware there are different kinds of financial risk, but we mostly are aware of the financial risk. So the financial risk is probably your counterparty risk. So we conduct due diligence of those whom we enter into a bilateral contract with. Then there is a foreign exchange risk. So if any of the companies are exposed to forex, maybe as an importer, maybe as an exporter, then they obviously go ahead and manage that risk. That is the foreign exchange risk because of the movement of the rates, cross currency rates. Then there is interest rate risk. Obviously, the interest rates keep fluctuating, depend bank rates. So that risk. So these kind of, besides these are the most popular risks, which most of the corporates at all levels, their financial legs, financial departments handle them. But one risk is also commodity price risk, which is not developed today as a culture. As a culture means each and every organization recognizing they have a commodity price risk and how do they manage it well. Though if you see, we are one of the largest manufacturers of different commodities and we are exposed to commodities in a number of ways. They may differ. Some companies may be focused more on crude oil or natural gas at the fuel feedstock levels, or maybe jewelers and all are exposed to more bullion prices. But that kind of risk, what they foresee, that is not actually recognized well in the Indian markets. And if we see on the electricity, I don't think there is any corporate who is not exposed to electricity prices in one way or the other. It may be less or more, but yes, though they may have the captive plants as well, captive plants for generating electricity as well, but still at some point in time, they are exposed to the pricing level in the electricity, which needs to be managed. So risk is nothing. We are standing here today at this level. Now, once we are standing at this level, nobody can predict future, though we may apply a umpteen number of forecasting tools. There are uncertainties which exist in the market always, and no forecasting tool can give you 100% result. That's a known fact. So when you're standing here today, the prices may go at different levels, scenarios. So what price risk management is particularly managing all these scenarios of the prices. So while I'm in the business of doing my business, I don't have to obviously daily take into account the commodity price risk I'm holding and accordingly maybe reduce my production or sales every now and then. So the better is that we manage our raw materials or the input cost or the electricity, consider it as a raw material. If you input cost to your total cost of production, prices may go at any levels, you should be hedged. Once you are hedged on those price levels, you need not worry about these movements. That is basically, in common terms, that is risk management. Now, once, like I have said, like no forecasting tool, because there are certain times like Russia-Ukraine war. So nobody could predict what kind, like if can any forecasting tool really predict the war is going to happen on so and so date? No. And we really saw post that the power sector related, what was the turmoil in the European sector? How the prices went really haywire. We have never heard of that kind of price levels of electricity, which the European region saw in post the Russia-Ukraine war. And so many companies just shutting down the businesses who were heavily exposed to this. They're just simply shutting down the businesses. And There were blackouts happening during different days in different countries. And gradually we have seen, while those countries had, though renewable and other sectors were there, but they now have parallelly created a coal-based generation of electricity as well. They have come back to those levels to avoid that kind of a pricing level. So that's the risk management. They've developed an alternative. They've come back to an alternative fuel which they were earlier using much, so that they can rely on that. That's one mechanism of risk management. Now, on the corporate sides, if we see, now your risk management can be, there is a pass-through mechanism. You can pass through, but in power sector, we know at different value chain levels, 100% pass-through is not going to be operative. It's not feasible. And obviously in the competitive markets today we are operating in, 100% pass-through mechanism does not work in any industry. So there arises the need for the risk management. This is right now we are saying risk management for any commodity. But we'll going down the slides, we'll see how for electricity it becomes all the more relevant today. So when we are managing the risk, this slide also brings in, once suppose the electricity derivatives are permitted in the exchanges, all sets of people will be, all sets of participants will be visible in those markets. On one side are our value chain, who most of you are part of this value chain right now in the power sector, maybe as a generator, maybe as discom, or maybe as a consuming industrial sector, or maybe at the retail consumer level as well. So these all are called the hedgers. They just pass on the risk, because the risk operates in a circle, within a circle. It doesn't move out of the circle, only that the risk is passed on from one entity to the other. So your risk when you participate in the electricity derivatives will get passed on to financial investors, because financial investor is in the market, or you may call them speculators, arbitragers, mutual funds, foreign participants, all are permitted in commodity derivative space. So they absorb your risk because they are in the business of risk taking. Value chain is here in the business of managing the risk. That's the entire gamut of participants in the commodity derivative space. Regulatory requirement also, if we see, even the regulator has understood whether there is a need for commodity risk management in the space. There is, in the annual reports of all the listed companies, under corporate governance section, this is one of the tables which is there in all the listed companies, where they have to declare which are the commodities they are exposed to. Now going ahead, this will also obviously include electricity. So what is the commodity you're exposed to? How much is your exposure? Are you keeping it open, or you're hedging that exposure? And if you're hedging, where are you hedging that? Domestic, international, OTC, or an exchange? Pramod, should I take the questions right now? Anything, or in the end?
Yeah, towards the end, I think we have not
Okay.
received much questions. So in case
Okay.
if any relevant thing comes in, I'll prompt you in.
Okay, thank you. So here I've just set the stage to you to understand or give you the broader perspective on what derivatives markets are and why people participate in these derivative markets on the different commodities which we discussed earlier. Now, why there is a need for electricity derivatives in India? India is one of the largest producers and consumers of electricity. Over a period of time, the short-term market is growing. Actually, short-term market is growing at a CAGR of around 14%, and the share of exchanges in the short-term market is increasing. So the spot exchanges, which Pramod had already pointed out earlier, there are 3 spot exchanges, electricity spot exchanges. Their share within the short-term market has also increased to 53% from 37%. Then there is a shift we are observing from long-term PPAs to medium-term PPAs. Shorter-term PPAs are still less, very short, but long-term 25 years to 12 to 15-year PPAs, that shift is now being observed in the sector. And obviously, there is an increase in across the participants in the value chain, including the generation level, because of more renewable part players coming into picture. So all these factors, because if a market has only a long-term market, then introducing maybe electricity derivatives wouldn't have been a right time. So, but now since the short-term market, whether you consider the bilateral or the exchange-driven market, the need is increasing on short-term basis. Obviously, when you have to participate in short-term, the prices at which you are going to purchase are going to be very volatile. And therefore, to manage this, you need a risk management instrument. And derivatives obviously is the best instrument to manage your risk at a very reasonable costing. So across 5 years, now these are the spot day-ahead market prices of the leading exchange. Across 5 years, if we see, this is a kind of a volatility which is growing on year basis. So there's somewhere, if we can average it out, also around 15%. Now, if I cite an example of Forex, many of you who are in this seminar may be aware, like a Forex foreign exchange volatility is not more than 4 to 5% anytime. It's the highest level. And we all companies do tend to manage that risk always. That goes as a benchmark. If we are exposed to any kind of forex risk, we have to manage, whether through banks, OTC, or currency derivatives, but that is managed, hedged. But this is the kind of exposure, 15% average daily volatility of the prices, which is currently being kept open-ended because there is no proper risk management tool available in the Indian market system. Now, for electricity, it becomes all the more important because electricity pricing is a very nationalized concept. Now, just to take if I have exposure to crude oil as a company, or maybe I am a glass industry and I'm having exposure to a lot of natural gas, I want to hedge it. Even if those derivatives are not available in Indian markets, I can go abroad and hedge. I can go to CME, and hedge that. For metals, I can go to maybe London Metal Exchange and hedge my risk if those are not available. But what about electricity? Electricity are nationalized prices. I cannot say if I can just go to Europe, I can go to US markets, US exchange, I can go to European Energy Exchange or Japanese exchange and hedge my price risk for electricity. No, it's not possible at all. So there again puts it a point how quickly we can make electricity derivatives available for the market participants as a risk management tool. This again, it's not a storable commodity, and monthly seasonality over last 5 years. If we see the rising trends in September, October, the x-axis is having the number for the month, and this is a percentage. So that's a kind of monthly seasonality we observe, and for a non-storable commodity. So just give it a thought what to do. The prices can, yes, obviously, I cannot shut down my factory only for the need. Suppose the demand for my finished product is high, but the input cost of electricity being high, I cannot lose out on my business opportunity. So what better is to manage that electricity price risk, the input cost, to manage my input cost, so that there are no limitations on satisfying the demands for my finished product. So while the need is, in fact, this slide is basically only because of on our getting engaged, like while we were engaging with the market, private sector, public sector units, specifically the PSU units. What we observed was this was coming as a query from almost every PSU sector to us. Now, the basic reason is अगर हम derivatives में participate करते हैं, if we are participating in derivatives, people tend to say you're speculating. That's the general norm, which needs to be broken. That shell needs to be broken. It's not, yes, there are speculators in the market, but it is their job to speculate. When you are in the market as a hedger, you are not speculating unless and until you follow the discipline of your hedge policy. So hedge position is like basic, if there is something, I'm going to take it from the spot market. There's something I am going to get it from the derivatives. So if there is a profit, if suppose there's a loss in spot market, I was bound to say buy a electricity at 5 rupees I had budgeted, but my electricity prices went as high as 7 rupees per unit. So obviously my total input cost has gone up. I have taken the delivery. Now, if I manage that through the derivatives position, this loss in the spot will be managed by profit in the derivatives market. That is the net hedge position. So we cannot consider the spot and the derivatives on an individual basis. It has to be spot market plus minus derivatives. So then counter reversely, suppose I have budgeted 5 rupees and I am able to procure my electricity, the input cost as 4 rupees per unit. So that time, since you are making profit in the spot market, you will have loss in the derivatives. But your hedge position is the net. So profit plus and minus loss, obviously your budgeted costs are intact. So that is why the concept I should not have anytime have loss in the derivative markets. People have asked me like, if we have loss in derivatives, we may get questioned on the basis कि derivatives में loss किया, तुमने speculative loss किया, तुमने सट्टा खेला. So
Ruchi, Acha, so I think many of our participants are from the South Asia region and may not be very comfortable with Hindi.
Okay. So basically speculation. So speculation is not permitted in the corporates. So if we are disciplined in our approach, then this kind of a hedge position, we should not convert basically for the profit in a small case, we should not convert back that the hedge position to a speculative position. And there can be loss in the derivatives market, but obviously it will be counter junction with the profit in the spot. Now, we have understood why there is need for electricity derivatives and then the need for Indian markets. This is just the proposed electricity just to highlight how currently we stand in the derivatives. Now, after the Supreme Court verdict, SEBI, who is the regulator of derivatives market, CRC, who is the regulator of the spot power market, they have formed a joint working group. That joint working group is working on giving the approvals for the electricity futures in Indian markets. So that joint working group has had multiple meetings and they're working on it. They're trying to bring out a better product for the Indian markets. So, and currently the approvals for launching electricity futures are not in place in India. So what are the key features which are being proposed is, since we already have the running spot exchanges where the delivery is being taken by the electricity value chain participants, the product which is being proposed for electricity futures is a cash settled or a financially settled product, basically for the risk management purpose. So the price quote obviously will go in line with the spot exchanges. It will be rupees per megawatt hour, which will exclude all the taxes and levies. Trading unit, this is a generally 50 megawatt hour to keep it small so that even the open access consumers can participate easily to manage their risk. But this may vary on depending on whatever the final approval guidelines come through. Tick size, which is being maintained currently, is rupees 1 per megawatt hour. Settlement, as I said, it's proposed to be financially settled product. And due date rate is basically will be based on the average of the IEX being the leading exchange I have mentioned, or maybe you can say based on the average of the spot prices for the day ahead market prices. So depending on the top contract type, the monthly futures is contract which is being proposed at the first initial stage, and later on, depending on the need of the market, various other multiple variants can also develop. This is just to give a brief highlight, because if finally whatever the approval guidelines come through from the regulators, that will ultimately let us know what the final contract specifications of this contract is going to be. But what will be launched definitely will be electricity futures first, because under the SEBI guidelines, options can come out, can be launched only once futures are settled in the space. So since now we have understood basically what kind of markets we are looking at, just want to give you a few illustrations. If suppose first of all, for a Genco or a generating company, how electricity futures can really help them. Suppose a Genco signs a power purchase agreement in June, say 23 or 24, for giving delivery of, say, obviously they are bilateral contracts, so they fixed 100 megawatt hours at 5,000 per megawatt hour or 5 rupees per unit. They have to supply in January 24. Now, since Genco is aware of this, they may try to hedge their positions through futures price. So since their bilateral contract is in place, they know so much has to be supplied at such a price, and they're assuming the prices may go up at that time, but they fix the price. So they hedge themselves in the futures market. So on 1st October, when they entered, it was 5,000, but 31st Jan, for the January month, when they satisfied the entire contract, they fulfilled the contract, the average pricing came out at 6,000 rupees, though since the contract was entered, they had to supply at 5,000. Now, if they are hedged with this market, if they actually at that time they had hedged, they will be making, so basically if suppose they are not hedged, then there is a notional loss of 1,000 into 100 megawatt hours, 1,000 rupees. Otherwise, if they've hedged their position, so they had gone and had taken a position in 1st October, 31st, when their contract is fulfilled, they end up the price was 6,500, they close their position and they make a savings due to this hedging. This make a savings of 1,000 per megawatt hour. And finally, we have studied like spot plus and minus hedging. So spot market was my loss of 1,000 per megawatt hour. In derivatives, we are making a profit of 1,000 rupees per megawatt hour. And ultimately, my budgeted costing or my budgeted sales, they remain intact. So my profitability margins, which I had expected, are intact. So otherwise, if hedging is not undertaken, then obviously my profitability margin for this particular contract is going to be impacted. And on the other hand, this particularly is an example, again, the similar kind of example, only to show prices may go on the other side also. See, when I'm hedging, I don't have to worry whether the price goes up or a price goes down. I have budgeted my cost, I have budgeted my sales, I have budgeted my profitability margin. So they should remain plus or minus something, but they should not go simply haywire. So if the prices move down, then what the corporate is making a notional profit. They're making a profit from the spot in the physical leg of it, while they will make a loss in the derivatives. So this is also very, very important to be understood, specifically for the public sector units, because generally their hedge policy and all do not incorporate the feasibility of having losses in the derivative markets. So this is a very much required need of designing your hedge policy, defining these things. Derivatives, there can be loss in derivatives, but ultimately my position is not impacted. Net hedged position is not getting impacted because I'm making profit in spot, losses in derivatives, and ultimately my budgeted profitability remains the same. That is very important to be taken into. So this is again for a discom, similar kind for the consumer or any corporate, again that kind of an example. So what basically needs to be taken care of while hedging is, one is every corporate should have a hedge policy, a properly designed hedge policy laying out the rules and regulations, all the limits within which they can hedge, providing for losses in derivatives can happen. Then the hedge what we are undertaking should be based on the physical market, whatever your contract period time, should be similar to your hedging time. So if my contract I'm satisfying is for 1 month period, my hedge position will also be open. Once the contract is fulfilled, the hedge position related to contract also has to be closed down. Now, sometimes this actually has happened on a daily basis. Like suppose my contract period, physical market contract was for 1 month. Say going down on by 25 days down the line, there due to some news or something, my futures position is showing me a lot of profit because the prices have changed the position. So a lot of profit is visible, and maybe the financial sector guy or the treasury management people personal just may think over, this is actually a real time, this has happened, only 5 days are left, what will happen in 5 days? Nothing is gonna happen. So they close out their position at a larger profit just to show a larger profit in the books, and those 5 days kept open. Now suppose those 5 days are the period when Russia-Ukraine war was announced, or maybe any hazard has come, a grid has shut down in electricity, we can say a grid has simply shut down and there has been a cyclone or something, and those 5 days come out very heavily on the corporate itself. So your policy and your execution of the policy has to be very, very clear. Your hedge position cannot be converted into a speculative position just to make some profit. Now, if we go on to just to give you an overall Indian side, it is said there is a need for derivatives in Indian markets. Globally, now the boxes with the white background are the derivative exchanges where electricity derivatives are traded, and with the black background are the spot exchanges. So if we look out here, yes, the Americas, the European markets, then we go to Singapore markets, Australian markets. What's the difference we observe in Indian markets basically is there are standardized spot exchanges doing good business, but what is missing link is the futures exchange, the much needed commodity derivatives or electricity futures. So in US markets, they are basically, just to run through is, there are US markets, they are on the basis of the counties, they have divided that, the spot markets, and all these contracts they have futures contracts pertaining to each of the markets also, which are traded on the derivative exchanges. Similarly, in European markets, again, country-wise, there are spot exchange, spot platforms or spot exchange. EPX spot is the main exchange where country-wise contracts are available. Then there is an European energy exchange where derivatives for those countries are available. Just highlighting the 4 basic regions, USA as the leading spot markets are Pennsylvania, Jersey, PGM, Maryland Power Pool. All these are the regional transmission organized, they call it RTO, and they have their derivatives available which trade on NYMEX, which is an exchange under CME group. There are different types of contracts, PGM or New York ISO, peak, off peak, they have annual, quarterly, monthly, real-time basis, all different contracts available because these have grown over, the types of contracts availability has grown and developed over a period of time. And the settlement mechanism is the arithmetic average of, say, if they am taking the PGM, so PGM markets arithmetic average or the timeline of the contract. UK, Europe, we already EPX spot, then there is a Nordic pool for Nordic futures. All these are country-wise contracts, and all these contracts, German, Nordic, Austria, these are available on the European exchanges, European Energy Exchange, which is the leading electricity derivatives exchange. They have a spot market index has been developed by EP Export. That's a settlement mechanism. Singapore, again, energy market company, is the spot market, and SGX is their electricity, is a derivatives market where one of the contracts is electricity. So again, they have different types of contracts, and average, arithmetic average, is the mechanism which is being adopted basically. And again, Australia, there is Australian Energy Market Operator. So ASX, Australian Securities Exchange, is the derivative, having different types of contracts. Again, arithmetic average is the mechanism adopted as a settlement mechanism. And in line are the contracts being developed for Indian markets as well. Sorry. Here, if we see the different maturity, actually both the markets, if we see the Europe, there has been a growth across the power futures. If just look at the kind of percentage growths we are observing. This is a growth being observed over last 1.5 year. And there have been statements made by the management of these exchanges. The participation is increasing from the value chain, not the financial investors. So when the participation is increasing from the value chain, it directly means the concept of hedging or managing the price risk of electricity is on an increase. Tocom, the Japanese side of it, it was just launched in 2019. And if we see the participation has gone up, the most important factor is out of the top, what this circle is showing is out of the top 40 electricity corporations or the electricity value chain utilities, top 19 are already hedging on the platform. So, and overall, there is a constant increase on the participation on the hedging side of it. These are some of the European utilities. They are particularly hedged ahead for 3 years, 2024, 25, 26. So if we see for 24, around 50 to 90% of the utilities are hedged, 25, 20 to 60%, and up to 40% for 2026. All these are the leading utilities, or European utilities. So that is the kind. Now these are on the generation side of it, electricity generation. So while the historical average is around 20 to 50 megawatt hours, they have a lock-in price range of, so they are able to get a better price once they are hedged for the future. So they are able to get a better price, and obviously better for the corporates. There are some research papers I just wanted to touch base on, because from the markets, what we generally, these are general statements or trends, which like the talking points which we see is, once the derivatives is introduced in a market, it may create a turmoil, or it may in that spot or the physical value chain. However, the research papers over a period of time have come out with a different kind of research ultimately. So there is a paper on in analyzing the impact of futures trading on the spot prices. And as per this paper, it clearly brings out this research over a period of time. Now, it's not immediately 1 or 2 months, or over a period of time, the spot price volatility reduces because of the availability of risk management tools such as derivatives in that market. So this, and secondly, the existence of a future market results in movement from the speculative to a more standardized markets practices. So what it really means is the spot and derivatives basically complement each other. Once the derivatives develop, it also leads to the development of the spot market, because going ahead, their need arises for different new kinds of products. Now, to that recently, just reading an article, European markets have introduced locational spread contracts. Now, in Indian markets, we cannot even assume right now, but maybe going ahead, we may require such kind of different kind of new products like locational spreads or maybe time spreads, seasonality spreads. Different kind of products can develop over a period of time. The only concept we need to understand is these markets can coexist. Spot and derivative markets have coexisted in India in different other commodities, and they can also coexist in a very regulated environment in Indian markets, and there is a need is definitely said. There is no second thought on that there is no need for the electricity derivatives in India. Again, another product, this is for the natural gas. This is not for electricity, but for natural gas. Again, the same concept. Post this, the market's prices have stabilized and they have each other, the spot and derivatives have supported each other. So thank you so much for this, and I can open the house for any questions, anything.
Yeah, thank you, Ruchi. I think there are questions. I think if you can go back to the slide on the product itself, there were a few questions around that,
Okay,
the product specification.
Okay, I'll just share.
And maybe,
yes.
So I think this was the most expected thing which the people were interested in knowing.
Okay. Yes.
So some question has come that what is the due date rate?
Okay. So due date rate is the settlement price. So since it's a monthly contract, so suppose it's a February, say January month contract. So the contract derivatives contract is Jan month contract trading from 1st to 31st. So due date rate is the settlement day of the on the date of the expiry of the contract. And this settlement price is, now MCX has entered into a licensing agreement with IEX. Now, since we have entered, so we will be taking their underlying MCP DAM price as the underlying. So average of the month of their day ahead MCP prices becomes this final settlement price of the contract. Due date rate is nothing but the settlement price of the monthly contract.
Okay. And these are settled on daily basis or towards the end of the contract? For example, 1st to 31st. So 31st January, this will be settled?
Yes, because if it's a monthly contract, it will settle on it will run for the full month period. But then it depends on the tenor. Like you have fortnightly, weekly contracts, then it depends on that.
Okay. And coming again on the duration of the contract, which we are proposing, at least in India, is a monthly contract. And
Yes,
how much advance it will be there?
It is proposed to be for 3 to 6 months. Final what regulatory approvals come through, but 3 to 6 months is the tenor of
expected tenor. Okay. And another question is basically again, since you might have also seen from my slides that there are two specific markets in which electricity is being traded in India, and this has been also used by Nepal and Bhutan, the RTM and day-ahead market. Here you are referring to the day-ahead market price,
Yes.
but not the RTM price. So is there a decision on this, or there will be separate products, or there will be some consolidated aspects?
So there's right now, Pramod, there's no decision on this. But whenever if RTM and all come out, they will be coming out as a separate product. Because your underlying markets, now in derivatives, you got to have some underlying. So underlying, since the spot markets, DAM, RTM are different, when they come into place derivatives, they'll be coming as a separate product. But currently, there are no guidelines pertaining to that. There are no restrictions underlying, but naturally, if we take the global experience also, monthly day ahead is the first type of a derivative contract which gets developed, and then they develop onto different, because market has to accommodate that, understand nuances of this kind of a product, and this is the simplest kind of it, because RTM again, and to launch a derivative you need a certain amount of liquidity in the spot market also.
No, so RTM market is also sufficiently, or may not be so much sufficient
too
than
much
DAM market.
sufficient,
Yeah,
yes.
but
Like if
half
there
of
is
it.
the GDAM also. So
Yes.
certain kind of a liquidity is required there also. but no restrictions right now on anything.
Okay, from the financial side, there is no restriction as in when
Right
the
now, these approval guidelines have not come through.
Hmm.
So after they come through, we'll have more clarity on what kind of a products can be.
Okay,
But definitely it has to be a different product if launched.
right. And one important aspect, in fact, because of which, in fact, we have considered to bring this session also was the regional countries who are basically bidding in this power exchanges. So either they are selling or buying power in certain months. So for
Yeah.
example, in 4 to 5 months they are selling, and then they are buying in certain session, and then they are having a exposure of the market. So once they are selling, they want to, let's say, maximize their revenue potential, and if they are buying, they want to reduce the cost.
Yeah.
And then possibly this could be one of the instrument wherein a blended approach can be taken. So in Indian commodity exchange, how is the policy for the neighboring countries, whether they are allowed to bid or participate in the commodity exchange? Currently they are allowed?
So currently in commodity derivatives market, foreign market participants, the FPIs, foreign participating institutions, they are permitted in Indian commodity, but there are certain rules and regulations where they can participate in, and they have to satisfy those rules. Because category 1, there are different type of categories they register in. So category 1 and category 2 are permitted as of now, and they are permitted in non-agri financially settled products. So those are the regulations, and there are FPIs who are already participating in our other commodities right now.
Okay. So there is a possibility, and then once the electricity.
Yes, just that they have to follow those rules and regulations.
And utilities are not barred to consider, means they can also possibly participate as an
As of now, in commodity derivative space, there is no entity which is debarred from, specific set of clients who are not allowed. There's nothing.
And for the neighboring countries who are connected to India also, there is no specific
No,
guidelines.
no specific guidelines debarring them.
Okay, this is, I think, a good point. One, I think, repeated question has come. Who are the risk takers in these markets? You explained, but maybe if you can
Yeah.
re-explain that.
So risk takers are basically the financial investors, or in more crude terms, if I say, they are the algo traders, they are the prop desks, they are the speculators, arbitrators. We also have right now mutual funds and FPIs, as I said, are all permitted. They are on the financial leg of it. So they are the risk takers in these markets.
Great. Another question is basically, will the country like Nepal need a separate approval from DA or CA to participate in the market? So just let me clarify on this. So for electricity market, basically designated authority or CA gives a clearance for participation in the market. However, for financial market, no such guidelines have come so far. So I think it will be governed by SEBI's law. As Ruchi has already explained, there are no restrictions, of course, with certain riders associated with it. So
FPIs are permitted. What we need to, physical market like guidelines may be different, but in SEBI, FPI categories are permitted. So it
okay.
depends whether these foreign utilities are falling in that, or they may have to register under that category under SEBI. So that will depend from case to case.
Okay, or maybe they may need to find another FPI in their country, and through them they bid or participate in
Yeah,
this.
FPIs are permitted as of now.
Okay. How is the bid shared among the successful portfolio if the quoted prices are exactly same and above MCP? So this is coming from the electricity exchange point of view, wherein the MCP is decided, and anything which is lower or higher matches with the MCP. So I think Jigme from Bhutan is trying to understand in case of.
So basically in derivatives, since MCP is like 15 minutes average of what they calculate, but in derivative space, whatever is the traded price. So whatever is trading and matching, just like in equity markets, Like there may be a buyer of any shares at 100 rupees. There may be a same day a buyer may be at 112. So wherever your trades have matched during the day. So same thing happens for derivatives also. And at the end of the day, there is a close price. So that's a regulated mechanism where last half an hour average traded price is calculated. That's the close price of the day at which the mark to market happens on daily basis.
Okay.
So there is no other intervention happening. You have to bring down the price of the trade. So whatever price at the trade, the order has traded at, that is the price fine. Only the set close price is different at the end of the day at which mark to market happens, like any other derivative markets.
And just I think I also got one question is like day ahead market only price is discovered once, unless like RTM market wherein you have a very frequent discovery of the prices. In case of day ahead market, then the prices are discovered once, then how it will impact the financial or derivative market?
So that actually prices, the exchange per se has no role to play in the pricing. The buyers and sellers themselves decide the price. All these, like to give you an example, like gold and silver contracts we are having on a platform. Now, there is no regulated spot exchange. In fact, electricity is one product where there is a regulated spot exchange, and then we are coming to derivatives. But the most of the commodities where I talked of, there are no regulated spot exchanges in the market. So if the gold bullion derivatives are trading, so those are there's one price maybe coming in for the jeweler, you get one price during the day. But the derivatives, so market pictures into by themselves lot of factors. Because see, this spot price is just one factor which will impact the derivatives. Because derivatives you're trading to hedge for your future. So there'll be a lot of fundamentals also playing, your supply, demand, your alternative fuels, what is the price of coal coming into picture, what is the cost of generation going ahead, how much renewable is coming into play. So the underlying price is just one factor which is deciding. So there is a lot of other economic and other geopolitical factors which will govern.
Okay.
Your demand, supply, lot of
Correct.
factors, and market pictures into it. Exchange does not play any role in getting into the prices at all.
Another question is, what will be the effect of electricity monthly future on DAM prices? Is there a risk that prices will be pushed upwards? What is the expected volume of EMF? Means whether there will be an impact on this to the electricity prices, or
So
these
that
are
is-
independent?
So that is what I clarified. This is a general thinking, but the research is, I have just shared you 2 research papers, but there are multiple research papers. Spot and derivatives coexist, they complement each other, they try to develop each other. But how they develop depends on the rules, regulations being governed, what are the surveillance measures put in place by the exchanges, both derivatives and spot as well. So like we were talking of different features, whereas surveillance, risk management measures, surveillance measures, the alerts, which 2 slides which I did not run through. So these are the surveillance measures which will actually help you govern these markets better. Governance is one side, but saying these markets will manipulate the other market, this is not the right thing, I guess. So
And
governance, yes, some structure has to be put in place, but otherwise they have coexisted everywhere. So they will coexist in Indian markets as well.
so based on the international experiences, maybe if you can share, so there is the electricity market or exchanges which are being regulated or monitored by, let's say, CRC in case of India, and similar is a case for SEBI, which is monitoring the financial exchanges. So whether there is a separate or there is any integrated approach in which these are being monitored internationally?
Internationally, see, if we say US markets, yes, they have the derivatives regulator, then they have commodities, CFTs, they have derivatives regulator is the SEC, then they have CME, NYMEX, but they also have CFTC, which is the commodity futures regulator also. So they have different phenomena where some components they jointly take up. And then these are the regional transmission organizers, the RTOs, the spot market RTOs. So there are certain factors wherein the information flow may happen from the one regulator to the other, and they may redefine themselves. But and if you take Europe again, Europe, your EPX, spot, and EX both are also governed by MiFID regulations. So both are governed. So that's a different. In agar we come back to Indian markets as well, there are currency derivatives, wherein currency actually in the spot comes under RBI, and so derivatives come under SEBI. So 2008, when currency derivatives were launched in Indian markets for the first time, again RBI and SEBI working group was formed. So they talk to each other. Regulators may talk to each other, but that's a different kind of scenario. But it happens globally also. It has happened in one of the commodities in India also. So it may happen in this also. SEBI and CRC regulators may talk to each other on different aspects.
Correct.
There may be information flow, but that is for the regulators to, and we may not be a party to it also.
Okay. Bhumika, if we can allow Rohit Khare to speak, I think he wanted to speak on, has some question. Bhumika, are you there? Rohit, can you raise your hand?
His hand is raised. Maybe in the meantime, you can proceed with some other question and can he
Yeah,
answer
Rohit.
that?
Yeah, Rohit
Hello.
can speak now. Yeah.
Yeah, thank you, ma'am. Thank you for such a nice presentation. Ma'am, actually, I want to add something in this presentation. As we are discussing about the implementation of the derivatives, I think we need to think something more about some tariff policies and distribution regulations. Because why I'm saying this, if generator is taking a position, then it is their role. And if we are not giving to consider an ARR, and it should not impact the power available to me, because janitor is just playing on the financial side. Now, if we are having the person discount side, then it has a cost and the risk implications. Whether it will pass the cost or the risk implications to the consumer, or whether the regulator will find a merit in doing so. For example, if suppose regulator says that you can procure a power in the short term, but there is a limit of ₹5, and there will be a problem if you go above from it, then the regular won't approve it, and the discoms comes and prays for please approve it due to some, and they start giving some political reasons, correct? Then accordingly it will get short-term power on an average, suppose ₹6, and which it might go up to the ₹10 says. So in the end, the regulator end up giving the leverage. Therefore, our aim is to find out the leverage and giving to the discom. So this kind of leverage problem can be hedged by the derivatives, ma'am. Once the regulator fix the cost up to ₹5, say. So that kind of leverage issues can be sought out by using the derivative products. This is my question.
Mr. Rohit, I think we can discuss in detail, because I really need to understand on what first of all, like, are you from the discom or
No, I'm from IT Kanpur. I'm working in the CER.
okay.
So we are working.
So
My also suggestion would be we connect this offline, Rohit. I think if you can drop a question, we will connect you with our experts.
No problem.
because
So
it involves a
one last
mix
question.
of, basically your answer will involve a lot of mix of regulations which exist in spot markets,
But
or physical leg of it, and
in
derivatives.
summarized way, if I ask, suppose if regulator fix the cost at ₹5, and the discoms purchase the power in the short term, suppose.
I'll stop you here.
And
We have another speaker also. So I'll
Okay.
connect you
No problem, sir, no
definitely, and we'll take your questions and reply to you. And Ruchi actually is interested in responding to it, but wanted to understand in the context. Bhumika, I think, with this we can wrap up the session, I believe. Thank you, Ruchi ji, for taking additional time, and I think you have explained all the nitty-gritties, but I feel that there is a lot of information again would be required, and will be again taking your time for explaining it to the more broader audience. Also, I think we are planning to have conduct a regulatory dialogue, wherein also we look forward for your participation in future. So thank you, Ruchi ji.
Thank you so much. On behalf of MCX, I really thank USAID and PTC to have come together to put this series into place, and it will be really a great platform to actually interact with a lot of people. Maybe sometimes we can have physical, the interactions are better, and come out with a better product. A lot of engagement always happens to design policies around what the need of the market is, and that will help us to bring a better product to the market. Thank you so much, everyone.
Thank you. Thank you. So, Rajesh, are you available?
Yeah, Pramod, I'm online.
Okay. So, just to give a background to our next speaker, Mr. Rajesh. He is currently serving as Chief Strategy Officer at PTC Limited. And he has been pivotal role in superheading the crucial capital allocation projects and strategic transaction with the organization. He has handled treasury operations at PTC India and PTC Financial Services, investing into the capital markets, commodity markets, including derivatives market. He is also overseeing the data analytics department in PTC. In past, he has served as a managing director at Neresis Consultant Private Limited, wherein he has raised the fund for alternative energy fund and other investments. He is a BTech graduate from IIT Delhi and postgraduate diploma in business management from IMT Ghaziabad. So now I'd request Rajesh ji to please proceed with your session.
Thank you, Pramod, for the introduction. Am I audible?
Yes, you are audible, and presentation
And is the presentation being shared?
Yes. Please proceed.
Okay, thank you so much. Yeah. So first of all, I think we went through a very comprehensive presentation before. So most of it will sound like a repetition, but I would try and wrap this up quickly through a trader's perspective or a market maker's perspective. And I would encourage if you have question and answers more. Before we start, I just want to make a quick disclaimer. Since we do not have this market as of yet in India, so most of these slides are actually stuff that has already been done, is available, is just put together, collated for a narrative perspective. So if you've seen this somewhere, in all possibility, you might have. So with that, Ryder, let me start. I mean, Ruchi has already covered what you do with electricity derivatives. I don't want to repeat everything. So just a couple of things that are unique to derivatives. I think keep in context is that you somehow treat risk and speculation as a negative word in terms of connotation. I don't know how that came about. If somebody studies the etymology of these two words, some of the original etymology was to look ahead or to observe. So these words are not necessarily negative in connotation, either speculation, they are both essential, or risk-taking. One of the few things is that I will draw your attention. The other three you have already looked at and seen. The fourth one is a unique perspective, because there are people with long-term contracts who are locked into their contracts. And they have entered into this contract 5-6 years back. These are 25, 30, 35-year PPAs over the life of the asset. And when they see this short-term volatility and people profiting out of it, they feel kind of locked out. It also sometimes encourages unique market behavior when you want to get out of these long-term contracts and play in the short-term market. Now, what these derivatives can uniquely give you, if you have a short-term view, you can express it in the short-term market. There's no need to mess around with your long-term contracts. That's a unique thing that the derivatives give you. The second thing is that when you talk about utilities, generators, and players in this electricity market supply chain, you always say that the rate of return, the return on equity is like standardized, it is small, it is because there is a certainty of cash flows. It is mid-teens kind of return. If you do well, maybe an extra 50 basis point or 75 basis points. But if you have this ability to trade in the derivatives market, you could actually boost the internal rate of return on your investments to actually private equity style returns. When I mean private equity style returns, it is like 20-25%. But of course, this is with caveat that you must understand the market, both the physical forward market and the derivatives market. So I just wanted to place that in context why these markets can add an extra dimension to what you do. Now, why is is that we are saying that there's a tailwind behind introduction of derivatives? So India currently has a short-term market, which is like, depending on your stats and numbers, between 12 to 14% of the overall market. So we see 100 BUs of electricity traded on exchanges, similar amount in the short-term OTC markets, but that's just 12 to 14%, and 86% is in long-term contracts. But in all intents, what you would see, the policies, the noise, the sound, or the signals that are coming out from the policymakers is that they want more and more of this volume to come from the short-term market, because that is actually a true representation of demand and supply and expression of that intent between a seller and a buyer. In India, we now have a jurisdictional clarity. When I talk about financially settled derivative contracts on electricity, we are now quite clear that it is SEBI to regulate. What this also allows is that it allows merchant capacity, which plays on the spot market, to actually add an extra layer. Most people that when you set up a 25 to 35-year asset and you go ahead and take project finance, there's a lot of issue regarding certainty of cash flows if you allow it to be a merchant capacity. So for those kind of merchant plants, it might still happen that they might need to tie up 70-75% of their capacity under long term to ensure debt financing. But the 25% merchant that they keep for the physical market, they can augment, hedge, or speculate on that capacity in the derivatives market. So it adds an added dimension. Secondly, more variable renewable energy sources. We have NDCs, and one of those aspects related to those NDCs is that we are trying to get 500 gigawatt of non-fossil fuel energy by 2030. And primarily, most of that non-fossil energy segment is going to come out of renewable energy. And where there is, and if it is not through long-term contracts, you need hedging to actually balance the returns from those assets, and therefore more investments can be crystallized. I don't want to get into all of this because I think Ruchi has already covered this. These are, these are basic parameters. This has not yet been launched, so I would be hazarding a guess. The only thing is that, as Ruchi explained, the underlying index can be anything. There are talks going on in the Indian market about market coupling, in which case all the three exchanges, the DAM segments, the collective segments might be coupled. So you might have one market, one price, which is a stated objective of the Ministry of Power, Government of India. And to begin with, we are talking about monthly futures. And as I said, risk management is one part of it. Speculation, increasing returns is another aspect of it. And as I said, these are not bad words. Again, this has been covered in the presentation before, so it's not something new to the global context. Multiple markets all over the world have electricity derivatives. They have either blended contracts where there is a mix of physical and financial settlement. There are pure financially settled contracts. There are different kinds of contracts, some for base load, some for peak. So there are a whole host of contracts that exist all over the world, and India is only trying to launch them. This was again covered. So forwards is something Indian market already operates in a forward market. Even our spot markets are actually a day-ahead market is a day-ahead forward. Physically, if you look at it for 96 time blocks, even an RTM is 1.5 hours ahead for 30-minute time blocks. So these are all forwards. That's not truly spot in the sense of a real-time market. Futures are essentially standardized contracts traded on exchange, financially settled. Swaps is interesting because I heard a lot of reference about currencies. So swaps are typically, you could design bespoke settlement contracts between two players. Internationally, swaps are governed by ISDA agreements. There are International Swap Dealers Association agreements. So under those terms are defined. Then, of course, there are options. And then there is a contract for difference, which is a unique thing for a variable renewable energy contract. And we can spend a little time subsequently on this particular contract on how it assesses a VRE-based generating asset or a utility that is procuring power in the spot market from these kind of plants.
Rajesh, just a request. I think abbreviations in case you can explain wherever you're using, please.
So OTC is over the counter. It is more like bilateral. So it is not a standardized contract. It's a bespoke contract between two participants. So that's why we call it over the counter or a OTC market. I think I am not used any other abbreviations as of now. But going forward, I'll keep that in mind.
Thank you.
As I said, forwards is something that we have already discussed. This is how the physical market operates. You buy or sell a fixed amount of electricity at a pre-specified contract price for a certain time in future. They can be tailored supply contracts when it is the OTC market. In the power exchange, there are standardized contracts in the DAM and the RTM. In fact, even the power exchanges these days have launched something like an ADSS contract, which are bespoke contracts. So, I mean, they are also continuously launching new products. But essentially, these are physical markets. So these are based on physical markets are more based on demand and supply considerations. So it's more like actual procurement and actual supply. There is very rarely speculation, although there is speculation between bilateral and exchange markets and long-term and short-term markets. So those kind of intersegmental speculation exists, and people do try and arbitrage between those segments. I mean, all of this has been pretty much covered in the background on context of why do we need derivatives. So you sell something. One thing you must understand is that you need a hedge when there is uncertainty. So the more you are exposed to a spot price, you are, there are two kinds of risk there. One is the market risk, which is associated with volume. So for example, when you participate in a collective market segment, you are not sure whether your volume will be cleared at the price at which you are quoting. So you are taking a market risk and you are taking a price risk. So essentially, you want to hedge that exposure. So the more that exposure that you have in the forward market, essentially, if you're exposed to that, and if you are a supply chain participant, you want to hedge that in the derivatives market, right? Of course, all of this has already been covered in the prior thing. In terms of the forward markets, there is a counterparty risk, there is a contract performance risk, there are creditworthiness checks, collateral requirement. Although it's not that they're completely loose, there are payment security mechanisms, LCs, BGs, but there are certain elements like contract performance risks which always remain. For example, if a counterparty fails to either generate or procure, so then you have to enforce contractually. An exchange platform, by coming in between through contract settlement process, I think Ruchi used the term novation. So it's essentially actually bridges this kind of a gap that exists. But exchange contracts have a certain limitation in terms of being standardized. The temporal aspect of it, right now, nothing more than 3 months exists on the Indian power exchanges. So that is another aspect of it. So if you want to hedge 11-month exposure, that's a different thing altogether. So those are the essential risks of a forward market through which you're trying to hedge through a derivative segment. This is an example, and this is in terms of unit economics, right? And you would have seen this slide across multiple presenters, multiple places. I don't claim any originality over it. So, for example, if you were a generator, let's take the case of hedging with the future. If you sold a futures contract at a future price at a certain rate, let's say 3.5 rupees, and the average spot price for procurement. So this is more like a procurer's example, not the generators. I correct myself. So if the average spot price during the delivery was 2.5, so you sold, no, sorry. So you sold in the spot market at a DAM at the average spot price of 2.5. right? In the futures contract, because you have taken a short position, right, you will have a settlement price of 1 rupees. So you would have that extra increment from the futures of 1 to lock in a price of 3.5 rupees. Secondly, the second scenario, if the price increased to 4.5 rupees and you have sold at 3.5, so you actually incurred a loss of 1 rupees, but you are still locked in at 3.5 because you got the spot at 3.5. So, sorry, you got a spot at 4.5. So the net effective is 3.5. So what essentially this particular illustration shows is that if you had a perfect hedge, which you rarely find, irrespective of your movement in the spot market, if you had locked in your futures contract at a price where there's a sufficient arbitrage between the spot and the futures, netting off transaction costs, you will still come out with a balanced tariff. So what you're essentially doing by undertaking these derivatives is you are transacting or giving away unpredictability with a certainty of tariff. Some of you might say that in the second scenario, if you had not hedged it, you would have generated 4.5, right? So, and you would have gained more returns. But you traded that uncertainty, the volatility associated with it, and for that certainty of 3.5 over a period of 1 month. So that certainty comes at that particular cost. So to most questions that people ask, that what will happen to utilities trying to procure, they are regulated and so on and so forth. Today, when somebody goes into the physical market and procures electricity even at a regulatory cap of 10 rupees, this is the answer. So this hedging cost is actually something that would assist a regulatory entity within those calibrated parameters. This is the second instrument, and now you might ask why somebody would go for an option and not a future. So the classical response for that is, as a practitioner, if somebody is able to predict trends, for example, you are more clear about the direction, then you should actually trade with futures. If you're uncertain about the direction, the options as an insurance mechanism, because, and I'm talking it as a buyer of the option, not as a writer of option, as a buyer of options, you are actually hedging against both side uncertainty. So generally, as a principle, and this is not cast in stone, is that if you can predict a trend, you go with futures. If you are not able to predict a trend, then you deal with options. But again, this is something that will be brought into the market later. Again, it is the same thing. The principle does not change, but the options have a very clear option premium. So that is a cost, that's a clear hedging cost that goes when you do an options contract. And options are distinct strike prices. Now, all of these assumes a level of liquidity in the market, right? It is not very, very straightforward. The markets are not extremely liquid as of now. As I said, it's only a fraction, 5 to 6% of the overall market that is traded on the exchange. And if you launch a derivatives based on these exchange prices, you have to understand the liquidity that is associated with it. And you can all ask questions. As I said, I'll just run through these slides. I'm happy to take questions and address them in the Q&A session. Swaps are actually financial contracts. So in the currency market, cross-currency swaps, interest rate swaps, and currency swaps are actually very standardized contracts. So you do a reference price, you decide over what period, what notional value as principal you want to settle it. So in fact, if somebody is exposed to a floating price of the market, for example, somebody mentioned they wanted to procure power over a defined period, let's say over next 3 months on the exchange, they're exposed to the exchange prices. Let's say just the DAM segment. So every day they are exposed to 96 time blocks prices on the exchange over a 31 day period. So you could actually exchange that floating price over that notional contract value with somebody, a market maker, who has a differing view and who is willing to offer you a fixed price for those floating price. So that way you can swap your floating price contracts for a fixed price contract. And who is this market maker? Not necessarily a financial guy, because for them it is, they maintain a book on both sides of the contract. It can also be a trading licensee or a market maker. who is willing to underwrite that swap for you. So that kind of an ability is offered in the swap contract, and swaps are basically bespoke contracts. We are still not there. As I said, we are still in the initial stages when we're trying to launch a standardized electricity futures contract with standardized parameters and tick sizes, contract volumes, exposure limits, and etc. But this is where the markets will evolve. So as I said, for example, as a buyer generator, so if a generator is selling to a buyer the physical commodity, but the buyer only pays a floating price, the generator, for funding, financing purposes, or even for the purposes that they are fine with a standardized certain return rather than taking on the fluctuating risk, can enter into a swap contract. So counterparty being a trader, and trader takes on this floating rate risk and is willing to commit to the generator a fixed price for a total contract throughout there. And the generator is willing to provide the trader with cash flows corresponding to the fluctuating price. What will the trader do? The trader would take a position on the exchanges and the market. So these books are always running. They are never one side of the segment of the book or the leg. So they always manage a book. Whenever a market maker takes a book on the derivative side, it's never a single side position. So, but what it does is, for the generator or the buyer or any utility, what it wants to do, it gives a corresponding exposure. So somebody wants a floating risk, you can do a fixed rate swap. Somebody wants a fixed rate price, you can do a floating rate. Either ways, and it depends on your ability to predict and your ability to actually manage and create and manage a book. It's a similar thing in terms of a supply hedge, in terms of a procurement hedge. I mean, the issue is who gives floating what. The essential purpose of the swap is that between two actual supply chain participants who are exposed to the market, the derivatives market requires, it could be a trader, it could be a financial, it could be a so-called speculator who can create a book and offer these offsets for fixed and floating and actually help you hedge. Or in a way, say that you make your cash flows more certain to whosoever wants those cash flows to be made more certain. And to be very clear, not everybody wants their book 100% hedged. If everything was 100% hedged, it's more like a utility trade and a fixed term contract. So everybody, the markets of tomorrow are going to be people saying market participants managing their books dynamically, which requires an understanding of nuances of these derivatives, understanding and nuances of who are the participants, how demand, supply, and prices are affected, and then being able to intelligently and rationally trade these contracts. As I said, we would spend a little time on this particular derivative from a trader's perspective, because this is something which is transcends the financial market to the physical market. So for example, you have variable renewable energy generators who want, fixed term PPAs for them to be able to raise project finance. On the counter side, you would have utilities who don't want to lock in these prices. So under one particular structure or arrangement, they could actually engage into a contract for different kind of an instrument with a trader or a market maker in between, in which this procuring utility can say that for a small token, for example, by taking the RE attributes out of the variable renewable energy generator, they could underwrite a certain base level of tariff. The market maker then actually sells this power into the exchange or spot market or through a OTC contract. When they sell it in the spot market and the forward market, they would obviously have a delta because the prices are not locked in. So this delta is to be offset by the utility underwriting the CFD. And in return, the utility gets an RE attribute or something. So this is the baseline tariff and the adjustment is the CFD. That's one form of CFD. You could create multiple forms of CFD essentially, where you underwrite a baseline of tariff, and there are participants who adjust that baseline of tariff based on exposures, contracts, and sale and purchase. So it actually serves the purpose of different utilities. Somebody does not want to lock in a long-term purchase contract. Somebody wants a certain long-term power sale contract. And this will help them bridge their requirements and help crystallize more capacity. So this is simply the same principle. If, for example, under a CFD, somebody generates more than the baseline which is being underwritten, the profits can be shared, structures you could devise in terms of who gets what. And if it is below, then the procurement utility underwrites that, compensates. So all of this is possible in terms of, the idea is that once you have defined a strike price, you have to actually adjust the CFD in terms of the strike price, both in excess or in short. This has already been covered extensively in terms of the presentation that was done earlier. Earlier in terms of the multiple types of contracts that are traded on different exchanges. There are physical and financial contracts. So most of them, if you see that there are financial contracts, there are base load, there are peak load, you could devise. But one thing is to be, underscored here, all of these contracts are effective only when they are liquid. There has to be a corresponding counterparty to your contracts. So it's not that my requirement is met every time and my requirement is met exactly. So there are multiple ways in which you hedge, and there are multiple ways in which there are complex contracts as well, in which you could hedge your input costs in terms of fuels, either coal or gas, and even take a counter position in the electricity market. It's not a clean hedge, but you could do that. So these are again examples which has already been covered in terms of the different types of contract. But as I said, the unit economics and understanding of unit economics under different contracts is more important. The rest is all a function of price and exposure. So how do you play? So one thing is that I think people often quote Warren Buffett when he says that derivatives are weapons of mass destruction. You might be on the other hand, Berkshire does underwrite, in fact, write a lot of super cat options. So the two actually conflicting views are because of your understanding of the nuances. If you should play in this market, if you understand the nuances, you need to have a strong assessment of the price volume movements of this particular commodity. You must also understand how price discovery happens. For example, when somebody says the underlying contract is based on the prices of the day-ahead market, the day-ahead market is a unique market where it is not pay as bid structures. Pay as bid are continuous auction methods. These are collective methods in which you stack volumes and prices, and you run an algorithm and you define a uniform clearing price. So there are risks that your market volumes at those prices may not be cleared, and you might be paid a single price, not the quoted price, depending on where you stack up. So you need to understand how the underlying price discovery happens. And of course, I think Ruchi said this well, that when you do all these kind of derivatives, you need to be able to set up mid offices and back offices. There are enough instances in the financial markets where the ability to not do proper operational risk management has led to exposures, almost debilitating exposures for underlying banks or investment banks. These are some of the abbreviations we have used in the presentation, and that's about it. I'm happy to take questions.
Yeah, thank you, Rajesh, for this examples. I think they have clarified, and some of the questions from my side would be that in the earlier contract we have in the earlier session, actually Ruchi said that in the European context they have some of the derivatives contracts going up to 3 years also. So in Indian context, I think currently we are talking about contracts up to 3 to 6 months. That's what Ruchi said. So is there a possibility that similar long-term or medium-term contracts are also will be available in India? Is there a possibility?
It all depends on liquidity, Pramod. As I said, even the spot market in India is not that liquid. If you looked at Ruchi's slides in terms of terawatt hours, they are like 60, 80 times the terawatt hours that actually we trade on our exchanges. So that is like we are just scratching the surface. So let's start with month ahead futures. Everything is possible. Like, but the farther that you go out into the markets, the more difficult it is to predict. So the amount of liquidity and the price differential might make the cost prohibitive. The longer you go to a 4-month contract, even if you look at even Indian markets, Indian commodity derivatives, the near month and the far month, the kind of spreads. So Ruchi was talking about locational spreads. There are standard calendar spreads also. So and if the markets are in a contango or in a backwardation, which is like subsequent month, the prices fall, which is backwardation, or in the subsequent months, the prices are higher, which is a contango, you behave very, very differently. And the longer term futures that you have, it is more susceptible to tail risks. Something like a geopolitical event happen, a fuel supply chain happens, outages happen, force majeure happens, all of those affect them. But of course, there are, as I said, there are people who write long dated options. There are things that you can do with long dated contracts. But as of now, we are taking baby steps. So let's get there. Let's get there with 3-month futures. As I said, exchanges have now filed a petition for a 11-month contract. And if those get operationalized, we have anyways the duration of the forward market on the exchanges is increasing from 3 month to 11-month. So once you have from a 3-month to 11-month contract, it stands to reason that you can offer 11-month product. So
Okay.
I think once we have more and more of this, we could do it. It's not about design per se or any construct. It's more about liquidity, the kind of participants that we have, who comes in, and who is actually interested in taking those exposures.
I see Ruchi ji also
Yeah,
wanted to respond.
Pramod,
Yeah.
just wanted to add here in, since because it's coming on the tenor of the contracts. See, there's a concept called rollover in derivatives. Now, if there are other commodities, like if I take the example of crude oil contract, now it has a 6 months tenor right now in Indian markets, whereas CME is having tenor of at least 5 years also ahead. Now, Indian commodity derivative markets are at very nascent stage, as Rajesh ji has pointed out. It's like on a very, very nascent stage, and we have to grow far. In electricity markets, what we are talking on EX and where we are today are far. But there's a concept called rollover mechanism, where the companies and the corporates are currently hedging in commodities, and 3 months down, like suppose you're taking a position in the 3rd month, when you come over to the 3rd month, the further contracts, you roll over the contract on month-to-month basis. So with that concept, even with 3 months tenor of the contract, you can actually go ahead and hedge your 6 months or 11 months or 1 year, because that rollover concept operates, and it really operates. It's operating well in other commodities where other corporates are hedging. So it will definitely operate for electricity markets. And going ahead, Rajesh ji said, as liquidity and the need from the industry comes into picture, your introducing new contracts, longer tenor contracts, is not very difficult.
Oh, thank you. Thank you for clarifying
Pramod,
this.
just to, clarify. So one is a technical term like rollover, but look at it from a practitioner's perspective, right? At the expiry of the 3-month contract, the next 3-month contract is also available. So what she's saying is essentially when you square off the 3-month, you can initiate a fresh position on the 3-month contract. So you break those 3-year exposures that you want to take. In every 3 months, you keep squaring and you initiating a position. But again, the prices, the cost, as I said, something is in contango, something is in backwardation, will actually determine your direction, the cost of rollover, as she said. And that is how you do. So these are not, as I said, these are not for participants who are just in it without a proper desk or without understanding the nuances. You need to understand these are these are products which require understanding both of the financial aspect and the physical market. Right. So with that word of caution, I agree completely with her. You could do a rollover by squaring off your position and initiating fresh, and you can do it for whatever tenor that you want.
Another question is on the OTC contracts. Since the exchange-based contracts are standard contracts, in case of electricity, we do have OTC contracts and other contracts also, which are beyond the exchanges. So, is there a possibility that such kind of derivatives might also come up? Again, it's again when depends on the market requirement and all. I understand, but
so the problem, Pramod, is that when you say derivatives, we are mixing concepts like derivatives, which are traded on the exchanges, to derivatives. Derivatives is a much broader class of instruments. I mentioned in my deck about swaps. They are derivatives, but they are bespoke bilateral contracts. Currently, there is nothing to allow us for that kind of a contract. So when there is an OTC contract, you can create a swap, but those are dynamically managed books, right? And those require far more nuanced understanding, your view, your ability to predict the direction and volume of the markets. So a short answer to your question, yes, even for an OTC product, you could do it. And even for an OTC contract, see, ultimately, for example, let's say I have an OTC contract and I wanted to hedge the exposure on the derivatives. I might not get a perfect hedge because my OTC might be a 1 month fixed term contract, but I might get a kind of a hedge in the 1 month futures on the exchange, even though the underlying is the DAM product, which is subject to its own demand supply. It's not a perfect hedge, but it is a hedge nonetheless, if I take an opposing position. So you must understand there are terms like clean hedge and dirty hedge. So you would have some amount of basis risk sometimes when you hedge it. You would have some amount of exposure left. You will not be able to hedge everything completely. You will be able to exposures offset some of these risks.
okay. So I'll take a few questions from the Q&A box. One question is that unable to understand the difference between financially settled forward and a CFD. What is the difference between financially settled forward and CFD?
So I think let's not call something financially settled forward. Although forward contract can be any contract which is in the future, and it can be a bespoke bilateral thing. So CFD is a far more complex contract than a forward. In a forward contract, the terms are fixed. This megawatt at this price, and then you settle it financially. In a CFD, there is a strike price in between. Somebody is underwriting that strike price. So if the final settlement price is over or below the strike price, somebody compensates for it. That is the contract for difference. In a forward market, that exposure, that settlement is that fixed tenor. So it is not similar to a CFD. The CFD has a strike price concept, the forward doesn't.
Okay, I think related question is difference between swap and CFD.
So let's, for the ease of understanding the examples that I took, the swap is mostly between two counterparties. The example that I took of the CFD was between three parties involved. A seller who wanted a fixed price, the generator, a buyer which wanted to retain the option of not going for a fixed price and may or may not take the contract, and a market maker or a trading licensee in between who was implementing the CFD. The buyer was underwriting the strike price of the CFD by compensating. If the price realized by the market maker or trading licensee was higher than the underlying strike price, the extra would have been shared between the three counterparties. If it was lower, the buyer would have underwritten it. So if you look at CFD, it's essentially, it could be a mix of like two swap contracts, but all the three parties are linked together. It's more like a tripartite kind of in the example that I shared. Again, don't go by jargons. Swaps are you're swapping something, right? Fixed for floating against a notional principle. A contract for difference is you're underwriting a baseline strike price and you're doing a delta. All these jargons don't mean anything. They are customized for your specific needs. So these are bespoke contracts, and they would have certain, for example, in currency swaps, there is something like an ISDA, which standardizes some of the provisions of the agreement, swap dealers agreement. So there would be an association that comes in. As I said, we are talking in hypotheticals as of now, but that is essentially what it is. So the forward markets, the CFDs, You must understand what you're trying to do in each kind of particular segment. Taking away and stripping the jargons, you're actually trying to deliver a fixed volume and price in the forward. You have a view on the forward market, and that is why you're agreeing into a bilateral contract. In a CFD, you're trying to underwrite a strike price, and somebody is offsetting the movements against that strike price. I hope I'm clear. If not, I can clarify that further.
No, no, I think it is clarified. And I think one session is not good enough. I think we would be requiring more such sessions, and people will get clarity on these terms, because many of the participants might be coming from the electricity engineering background and may not be very much exposed to the financial markets and the terms which are being used. So another question is, can the derivatives market help in increasing the liquidity in the physical market? It's a hypothetical question, but yeah, is there a possibility?
Interesting question. So there are two things to it. When I describe the CFD contract, right? Again, when I describe the CFD contract, I made a statement that it will crystallize investment in the RE capacity. So which increases the volume in the spot market, the merchant capacity. Because somebody who wants to set up merchant capacity wants certainty of cash flows and project finance and debt funding to set up that capacity. And if they have a floating rate contract and somebody wants to underwrite that, if a CFD happens, yes, the derivatives will crystallize more capacity, which will come into the spot market. So to that response, that particular arrangement, yes. If the question was, would a futures market crystallize more capacity in the spot market? It can possibly do it. Again, with the same argument that you might be able to get more certain cash flows by hedging your risk. But again, it's a question, as I said, the market is nascent, the product is not launched. Number of participants, the kind of liquidity that these products offer, there will all be a function. But to a theoretical question, yes. The CFD, definitely yes. The futures, the jury is out, but we'll see how that happens. But yes, possibly it can.
Okay. And again, a related question is on the REIPP. So REIPP who is struggling with the forecasting energy production. So can the generation level rise because of this electricity derivative?
No, clearly no. The generation level is a function of your plant's operational parameters. Let's say you are a solar or a wind plant. Let's just restrict that for a moment. Your operating characteristics in terms of your condition of your asset, the amount of natural resource that you have predicted, and the plant. In case of solar installations, the GNI that you predicted and you got it. In case of your wind plants, the wind speed that you predicted at that particular hub height for your wind plant with all those parameters. That is the function. The weather, the climate change, all of that affects the generation as well as the condition of your asset. The only variable that you have in control over there is the asset quality in terms of minimizing your downtimes. Derivatives cannot help predict your physical generation. That forecasting is more dependent on your asset quality and numerical weather prediction. Derivatives can help you hedge your exposures. When you are a generator, you are short already on the market because you have sold the power under a PPA to somebody. So if you wanted to hedge it, you take for a short position, you take a different position, a long position, or whatever you want to take in terms of your ability to predict. But short answer to your question, your actual generation does not have a bearing on the derivative markets. It's the other way around.
Okay. I think with this, we will close the Q&A session. And if some questions are unanswered, then we'll try to respond to it offline. That will be there. So thank you, Rajeshji. Now I'd hand over Bhumika for the last session, concluding session.
Thank you, Pramod, and thank you, Rajesh ji. Thank you, Ruchi. And in fact, thank you for all your information, all the knowledge you have shared. And thank you, Pramod, for facilitating the technical sessions and taking up so many questions and helping the speakers answering so many questions. The contributions have been really, really engaging, and I'm sure that all our participants have benefited. And a heartfelt thank you to each and everyone who's been with us throughout the session, the participants from South Asia, and of course our speakers. And we see that there are many repeat participants also in the session. So we understand that you are enjoying the sessions and you are learning a lot from these sessions. So Ruchi Shukla and also Rajesh ji, again, thank you for all your knowledge and your presentations, for your time. So your presence has definitely added to the best of this session, and your efforts are truly appreciated. A big thank you to the backend team, from the technical team and the backend team, who have been working behind the scenes for planning of this session. We have witnessed a very huge number of participants, and we hope to see more of these participants in the upcoming sessions. Like Pramod has already mentioned, that we plan to do 2-3 more in the same series of electricity derivatives. So please do stay tuned to our social media pages and the emails we sent out for information on more of such sessions. So I have also copy pasted the social media links to our SAREP and SARE pages in the chat box. So please feel free to follow these social media pages for more information. Any of the queries we already mentioned in the beginning of the sessions, you will receive an email from us, so you can reply to that email, our email ID, and we'll be happy to assist you. Any more topics you would like us to take up for such online learning sessions, so we'll be happy to assist with that. Please do reply, and we'll also be sharing a Google link for your feedback, the PPTs in the next 10 days. Pramod had already mentioned, so you will receive those informations also. And with this, we come to a close of this session. I hope it was an enjoyable learning session. Thank you again for your time. Namaskar.
Thank you